This will be fun. All right, distribution and legacy time. Part number 1, current plan. What does the income look like? We're going to model this out live and then plug the numbers in here. So, income he receives, 200, I wish. Social Security, $25,000 per year. We just plug that number in. Could be a little bit higher, but $25K per year. Now, based on his current plan, he was stockpiling cash. If you recall, if we go back, that's going to grow if he just continues to save at the present rate he is to 2.69 million. Okay. So we've got an annuity here of 2.27 million. The reason why is he did want to leave some money in cash, meaning we don't want to completely drain every penny we have and put it into an annuity, or if this was a real estate syndication deal. Basically, where the annuity came into play is looking at an income portion of the portfolio. How do I just guarantee an income stream? Because I can just spend it down in cash, but I don't want to do that. So what does it look like here? Let's take a look. So we're going to look at an income annuity. Age 65 is when he would purchase this. Purchase payment, $2,270,000. Annual income coming out, a little over $116,000. And this is income for life with a cash refund. So what that means is this will pay him $116,000 per year forever, for the rest of his life. If he dies early on, let's say you dump $2 million into an annuity and you die the next year or die 5 years into it, does that mean all of the money is gone? Could be the case depending on the option you selected. Is it a lifetime income only option, or is it an option with a cash benefit? Does my surviving spouse receive something? We're going to look at that briefly next, but there is a death benefit on this if he dies. However, here's the income. What's also nice to look at here, the cumulative income. So at one point in time, or how many years does it take to exceed the amount he dumped in? Almost $2.3 million by age 83 here. With those income payments, he's received that much, a little bit more. Okay. Now if he keeps going, which he's a healthy individual, till 90 or 95, what does this look like in terms of cumulative payments? Because the income remains consistent. Age 90. $3 million total. Age 95, $3.6 million. That's the total amount I've pulled out from the product. So really, in order to guarantee an income stream, we looked at an annuity here. I've got mixed feelings on annuities. If I want a guaranteed income stream and I don't want to think about the money, I'm not into the market, I'm not into syndication deals, anything like that, it can make sense. It's not for everyone though. It's an option, which we're all about transparency and options. Let's continue on. So investments, $2,080,000. In fact, a little bit higher as we adjusted that model, $2,120,000. Let's make sure we fix this. All right, so we kicked the assumption rate down to 4%. Since now he wants to pull income from this pile of money, does not want to keep it in the aggressive 7%, 4%, we've got the old saying, conserve your principal, live off the interest. That would be his plan to say, all right, I don't want to run out of money. So what's it look like if I just peel the interest off? So what we're going to do is plug in $2,120,000 and see what it generates. First, the income over here with the annuity was what? $116,000. We're going to tally all these up. So far, you got Social Security, income from the annuity. Now let's see what the investments produce. Okay. 2.12, correct? Yeah. Present value, $2,120,000. 4% assumption. This can be 35 years. Doesn't really matter. assuming age 65, forever. So in this strategy, all we are doing is having that bucket of money, a little over $2 million, sitting in an account, producing 4% and living off the interest. This is an extremely popular concept among retirees. Hey, I built up my nest egg. I don't want to run out of money, but I built it large enough where I'm comfortable with the income that it produces. And it works if we've built it large enough. However, if we leverage things right, you can do a lot more damage with a life insurance policy. And this, it's not to say one's better than the other. But what this produces, 81.5, okay, forever, and he never runs out of money. 81.5. So far, Social Security, annuity, investment income. Also, real estate, $4 million portfolio, rental income at 4.5% is what? $180,000 per year. Okay. Always good to validate the numbers. Of course, we can use a calculator on our own if we're watching this, but still, I like to show it. Even the simple things. That's always, if I'm ever working with a professional, when they actually go through the numbers and show it to me so I can see it, not just hear it conceptually, I like that personally, just from a consumer perspective. So we always try and do that with everyone we work with. So as you watch these videos, if you are, thank you for watching. But if you ever have comments or recommendations, feel free to let us know. Feedback is always appreciated. So we've got our income sources of what? 25, 116, 81.5, and 180. Let's tally them all up. Let's see it again. Looks about right. Just about 400 grand per year in total before tax income. Okay, so where we mentioned before, he'll be fine without us. He'll be fine without us. He's been building his net worth, and he has been aggressively using that cash he got. He put it to work. Did a great job with it. So total income, let's just round it off at 400,000 per year. And then the legacy, 8.81. However, taxes and inheriting real estate, which one of his sons he works with or works with him on real estate projects. He's heavily involved. The other ones, not yet. They may or may not, but again, they might go off and do their own thing. That's something to consider with real estate if we're really building that up and we're concerned about leaving a legacy to our family equally if we're not set up with a trust or anything like that yet. So let's continue on here. This is kind of neat, right? When we start to lay everything out, there's our current plan. So going back to the beginning, before he met us, now what's it look like based on the alternative or alternate, where we looked at the cash value life insurance policy. So the alternate plan involved taking approximately $1 million, a little bit more, and moving it over to a cash value life insurance policy. And we saw the buildup. By year 5, we broke even. We paid in $750. We had more than $750. And by age 65, we had over $1.7 million in cash value. Okay. Now, what does that look like on the distribution phase, and how do we actually leverage it to give me the same or more money today, and then also leave more money long term in terms of legacy? Let's take a look. So, age 65, Social Security, $25,000. That's not going to change. Cash, built that up to $1.22 million. Because we extracted how much of that? A little over $1 million and moved it over to the life insurance policy. So what we want to look at is what's the impact now if we spend it down? So here's what we're going to do actually. Let's look at a couple things. One is an annuity. So we want to compare and contrast different annuities. So this one, $1.22 million. Annuity with no cash refund. So what that means specifically is I plop $1.2 million into an annuity. It produces a little under $70,000 per year for the rest of my life. I purchase it at age 65. But if I die at age 70, I paid in 1.2. I received a little under 70 grand for 5 years, and that's it. We selected no surviving benefit, no cash refund, no nothing. Why on earth would we do that? Well, the reason why is we wanted to maximize the income potential because we've got the death benefit on the life insurance policy to leverage it. Now, not everyone's comfortable with that. We might elect to have a cash refund option. And actually, what we can look at here, we can do this on the last piece as well, is this guy. So we selected the life income option. Here's different options. That produced $69,000 if we have life income with period certain for 20 years. What that means is for 20 years, there is a cash refund period. Let's go back to the first example we looked at because I neglected to show this. This is with the $116,000 per year. Same thing. So if we select a cash refund like we have right here up top, 116. If we just selected life income, it would produce about $129,000. But life income means the income is being dispersed, and if I die, none of that principal balance is left to my heirs. With a cash refund, that principal balance is left to my heirs. There's additional options to this. I can select an option where I have a surviving spouse. It could be a survivor annuity. So if I die, the income continues to be paid to my beneficiary. So there's different options. But to go back to what we were talking about here, the annuity, based on the 1.22 million, produces about $69,000 of income for the rest of his life. Okay. The other option we can look at is spending the money. So from age 66 to 85, a period of 20 years, what would that produce if I just spent it? If I didn't buy an annuity with it. I want control of my money. So if I want to spend it on bigger ticket items, I'm not locked in to that $69,000 per year payment. Here's what it would look like. 1%, because we had cash, but 20 years. If we just spent it down at 1%, about the same, $67,000 per year. So the annuity would make more sense unless I like having the cash there to continue to invest in real estate. What we're going to look at as far as the model is the annuity. Okay, so I've got Social Security at $25,000 per year. This is the alternate plan. Spending down $69,000 per year, or using the other annuity, I should say, from that cash of $1.22 million. Now, we've got the investments in the alternate path of a little over $2 million, $2,080,000. We want to look at the same 4% assumption here. 4% assumption. $2,080,000 is wrong. It's actually $2,120. And for the next 20 years, we are going to aggressively spend that down. So same 4% assumption, but let's spend it down. 20 years. So it produces just about $150,000 per year. So what this means here is we are not going to live off the interest only, like the last example based on his current path. We're deliberately going to say, all right, I want to take your money and drain it by the time you're 85. Over the next 20 years, same account, same 4%, but we're going to have zero left in those investment and particularly qualified accounts that are left on in the least efficient manner possible. So $150,000 per year coming out for a period of 20 years, balance is zero. Nothing. Okay. 150, let's plug that into the model. So what do we have so far in terms of income? Social Security, $25,000. Spending down, $69,000. $150,000. Let's do this actually. 150, 69, 25. 244 thus far is what we're at. Okay. Keep that number in mind. We're going to come back to this. So 244. Now, the real estate, $4 million, exact same thing as this calculation. producing it at the exact same 4.5% rate, which is going to give him what? $180,000 in retirement income. So let's add that, 424. So during the enjoyment years of his retirement, total income is what? 424. Now, when I say enjoyment years, here's specifically what I mean. Is when I first retired, 65, those are the golden years, correct? Meaning I've got more energy, I just retired, I'm spending time with the family, going on vacations, I'm having fun. As I grow older, if I'm in my mid-80s, am I doing as much as I did when I was in my mid-60s? Some might. I look at Clint Eastwood and think, wow, look at that guy go. He's 90 years old and still moving. Oh, he's just taking care of himself. But it does look like he's slowed down a little bit. The older we grow, the more we slow down, means we are likely spending less money as we grow older. We're not doing as much unless we're gifting it. A lot of people do that. But my point here is we wanted to spend down the least attractive assets, the qualified money, while we were living. We don't want to leave that. If we're interested in leaving a legacy, qualified money typically is not the way to go. So $424,000 per year is what we were able to pull out through age 85. But the thing is, we've drained our investments, and the cash, we did leave some cash. If we go back to the model, we do have cash there, but we've locked it up here in an annuity, so we're getting a little under $70,000 per year. So in this example, what do we still have? We still have the real estate income, and we still have the annuity payment. So 180 plus 70 there, call it. You still have 250 per year and Social Security. He's doing fine. This is really just meant the last piece to show how the life insurance secured everything and put him in even a better position. So by age 85, what does the life insurance look like? Let's take a look here. So we can go back to the model, but what we're going to look at instead is this guy. So this is his policy that we looked at on that detailed illustration. So we've got $150,000 per year for 7 years going into the policy. Total of $1,050,000. Break-even point, year 5. Looks great. Cash value continues to grow. What's it look like by age 85? Keep going. There we go. Age 85. 4.3 million in cash value, 5.6 million in total death benefit. Now, what does it look like if he decides to continue to pump money into the product? Specifically, we mentioned earlier that a plan of his was to potentially, after the 7 years of funding, continue to fund $50,000 per year for a total of $1.5 million into the policy. So if you have a flexible policy where you can adjust payments like that and add more money in, what is the impact here? By age 85, for example, with just $1 million, 4.3 in cash, 5.6 in death benefit. Here, about 5.9 in cash, 7.7 in death benefit. That's an impact. Larger cash value and larger death benefit. The death benefit is really the advantage there when you look at it. And as you get older and trying to leave a legacy, that's where life insurance is very powerful because he was able to leverage his other money, spend it more aggressively, the $424,000 per year, going back to the plan. So here, 424 is what he pulled out. But now at age 85, his cash value, in the example where he only funded it for 7 years, is 4.3 million. Death benefit, 5.6 million. Income still coming in. The annuity, I'm just going to round up at 70K. in the real estate. Real estate, man. That's what did it. For a total of $250. I'm sorry, I forgot the Social Security. $275,000. Okay, great position. If he wants more income, he's allowed a large cash value life insurance policy to sit in the back burner and just continue to stew over time. Keeps on compounding, gets better and better. Meaning he can pull out another $200,000 per year in income or more than that. At his current pace, what he's doing, he's not going to need it. But where it helps now is he can leverage money much more efficiently through the cash value life insurance product. Now, lastly, what we want to touch on here is the legacy play. Legacy planning. What's he got going on? Real estate. By age 65 has grown to $4 million. By the way, we stopped the appreciation at age 65. That's going to continue to appreciate at the end of the day. He'll likely continue to raise the rents. Maybe he'll sell it off. And then what's he do with the money? So him investing in himself, growing his real estate portfolio, that's what put him in this position. It was the personal development, him moving forward, like that's what did it. He was the biggest factor. But in this example, still has $4 million, still producing $180, and he has a life insurance benefit of $5.6 million. He had 3 kids. So if he dies, say at age 85, and one kid, his son that was managing real estate with him initially, let's assume he is the one to take over the real estate, but the other 2 kids, I mean, they're still entitled to a part of the inheritance. How do you break that up? Do you divide the real estate 3 ways? Sometimes families have issues over that. Some don't. Some work it out fine. Depends on the family relationship. Well, a life insurance policy now allows those proceeds to help go to the 2 children that were not managing the real estate. The other son still receives some of the proceeds, but also receives the full real estate, meaning they're using the life insurance to buy out a portion of the inheritance, depending on what he wants to do with the real estate. If that made sense, we can talk about that more later. I don't want to get into detail on that. Let's touch on this. That was really meant just to touch on how we can leverage a life insurance death benefit to cleanly pass money on. We'll close with this. Does life insurance actually work? That's a great question. Does it actually work? The answer is yes. And what I specifically mean here is so often people see these projections, we hear about whole life insurance potentially working, but then we get into it and just hear, hey, it got worse and worse every year from what that actual illustration represented. The thing is, the policy design and company selection have a huge play, but if it's designed properly and it's set up with the right company, it will perform. It does deliver. If it's not set up properly, that's where we hear all that bad stuff about whole life insurance. So let's look at what this individual has actually done. So this plan was set up in 2016. So we put this policy in force and we've been able to track the performance since. And what I want to look at here is how has it actually performed? What was his break-even point compared to the original projection? Now I'll add, from the other examples we looked at with the 150 for 7 years, that was a different product. The product he has is a whole life insurance policy, but it's no longer available because it was issued in 2016. They discontinued that particular product. The one we showed was very similar to it. However, let's look at the numbers. So he took those deferred compensation plans, look at that, for 4 years, followed the 150 path. His plan was actually to pay in 125 in year 4 because he pivoted a bit. Guess where he put the cash? Real estate and other business ventures, very active investor. But paid in 150, total of 600,000. In 2016, the insurance company he selected had a 7.1% dividend interest rate. He paid in $150,000, and the cash value in the first year was $128,000. That's what it actually was. This is actual performance. What we did, this is an in-force illustration projecting forth everything beyond year 6. But what we did with these values, we track the values year to year with everyone we work with. But for this particular case study is we pulled the annual statements, looked at the cash value, looked at the dividend statement, the death benefit. Some years he had loans, so we had to see, okay, here's what it looks like with loans. Here's been the constant dividend performance. Looking at the entire picture, it's important to measure that. But we were also able to track when it's designed properly. Look at that. Break-even point between years 3 and 4. Dividend interest rate, 7.1%, then came down to 6.7, 6.4% for 2 years, 6.2, now it's 6%, gradually been trickling down as the yield environment has been very, very low and has remained low for a long time. His bank account in 2016 has not improved in terms of a yield between then and now. Just to add that in there. So, continues to add money, looking at $50,000, or he paid in $50,000 2020, 2021, $35,000. May have done that last year, actually. I'm going to have to redo this model. But it illustrates the point here. Continues to make payments. Now, what's interesting here, look at the total amount he still wants to get into the policy. Funding now until age 65 at a reduced amount because his plan has changed. He's pivoted a bit, looking at other business ventures, investing elsewhere, still doing very well. Utilizing it and leveraging the policy very heavily for real estate opportunities, but we see what it's actually produced. This column here, I just want to touch on this. So we've got that dividend rate, which is a gross rate, always credited after the company's insurance expenses and mortality charges. It is not by any means what I'm actually earning on a life insurance policy. Anytime I look at the actual growth rate, this is very, very important. I want to look at the internal rate of return. So here, we've got the annual internal rate of return. First year is negative. So the company illustrated a 7.1% dividend rate, but I paid in $150 and the cash value is $128. I don't care if I have a 1,000% dividend rate. If my money is less than what I paid in, that's a negative 14% return. Year 2. I pay in $150. It grew from $128 to $273. That's almost a negative 2% internal rate of return. What happens with the base premium in the first and second year? If you recall that piece of the case study, nothing shows up in cash value. Beginning year 3, base premium comes back. I'm compounding, gets stronger and stronger year in and year out. And this, the beauty of it, is what's actually happened. We pulled it right from the statements. We love it when the plans work out, don't we? When they don't work out, that's when typically you don't see or see any information or don't hear about it. But here we see a policy actually working because it was properly designed. That's the key. And we see the projections moving forward, but we've got to keep track of it year over year because things change with the dividend rates and such. No, that's a lot of information there. And part of it was really just meant to show how life insurance fits into the plan. I know most of our content is laser focused around how to design policies for maximum cash value. A lot of people we work with do not want this comprehensive plan. Some do, but most say, hey, I've got the planning set up. Here's the amount of money I want to allocate toward a policy. Show me, Steve or IBC Global, how to optimize the cash value. That's what I'm interested in. And I also want to use it for real estate and such. Help me project models there, but I've got it, I'm good. But if you'd like to see any kind of plans like this, can certainly help you, or you can take these videos and look at any models we put together for you and see how they fit in the plan. So I do hope you enjoyed this one. No, it was a ton of information. I enjoy them quite a bit. If you have questions, reach out anytime, and I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.